If you ever thought, I wish I bought in that suburb before it took off, well, this is your chance to catch the next one before it's obvious. Booms don't come out of nowhere. There are clear signs and very early markers that a suburb is heating up well before the price charts show it. And in this video, I'll be walking through the 3 biggest signs that your suburb might be next. Hey everyone, my name is Nick. I'm a director here at Handle Properties. We're a boutique buyers agency helping Aussies buy investment properties starting from just $400,000. But more than that, in our business, you work directly with myself and my business partner, AJ. We're both ex-investment bankers and hedge fund investors, and we've personally built $5 million plus property portfolios each before the age of 32, while working full-time on single incomes. We didn't rely on luck, we relied on the numbers and spotting those early stage booms. That is our bread and butter. We do it for ourselves and we do it for our clients. Now back to it. The first and most powerful sign that a suburb is getting hot is a sign of a tightening rental supply market. If the rental vacancy rate drops below 1%, that is, less than 1% of all the properties available in that suburb is currently available for rent, you're looking at an emerging crisis for tenants, but a massive opportunity for investors. Why? That's because rents rise before prices do. When tenants are queuing up for a limited number of homes, landlords start increasing that weekly rent. And suddenly you go from a situation where a property was previously $400 a week in rent to now getting $500 or $550 a week in rent. And what does rising rents do? It improves rental yield and therefore makes a particular area more attractive to investors, which can drive up capital growth and demand as more investors come into that market to buy those properties. Suburbs with consistently low vacancy rates, especially those that are trending down, are flashing green lights for property investors. The second signal is what I call buyer urgency, and you can spot this through a metric called days on market. This is how long, in terms of days, it takes for a particular property to sell once it has been listed. Now, if a property that used to take 60 or 70 days to sell is now flying off the shelves in 20 to 30 days, the psychology of the market has fundamentally changed in the last 12 months. Buyers are more confident, they're either coming in more pre-approved, they're making quicker offers and often above the asking price. And that's a function, of course, because an agent puts up a price, and if it sells really quick, someone's probably snapped it up at that price or willing to pay a little bit more. Falling days on market is a trend that helps you identify if that demand is heating up. So what might be seen as long days on market, call it 30 days. If it was 30 days 12 months ago and 30 days again today, that's, it's not really moving. But let's say it was 40 days a month ago and this month it's 30 days, that trend is moving and it's in favor of property investors, and buyers are acting fast to secure what they can. This is a key consideration for that price acceleration, especially in the first 12 to 18 months of property ownership. The third sign that we look out for is money flowing into the area. Now, I'm not talking about other property investors. I'm talking about big business and government spending on infrastructure. Think about government spending on new ports or hospitals or train lines or roads, or private developers spending hundreds of millions of dollars on new shopping centers or new clinics or new factories that would bring in more jobs into that area. All of these things are happening because those big companies and those big businesses have done the research already and have already backed it with their dollars that that particular area is an important strategic reason for them to expand their business or build that hospital or build that particular port. They're betting on that future population growth, and that means long-term growth in jobs, residents, people wanting to live there, so that's housing demand, and that's going to increase prices. But here's the trick. Infrastructure doesn't instantly lift values. There's always a lag. So the smart move is to check the data and see where things are going in before they actually start going in. So think about, when are projects in their approval process and likely to kick off. So by the time the ribbon is cut and that project is completed, you've already taken that upswing on the 3-4 years beforehand that project got completed, where there was already buzz in the market and activity going on about that particular project coming online. So what to do next? So if you're seeing all of these 3 signs in a suburb, low vacancy rates, fast sales, and new infrastructure, that's not a coincidence. That's a suburb primed to boom. But most people don't know how to read all of these signals, or they look to wait much after the wave has passed. So if you want to learn how to spot these early growth metrics, comment the word handle below and I'll send you my personal free suburb checklist. We actually look at over 30 data points and I've only talked to you about 3 today. And so you can see exactly what those data points are and where those sweet spots are. But of course, if you want someone to do it for you, that's what we're here for. We can help you find, finance, and secure the right property in the right market. Just head over to our website, www.handleproperties, click on the link, start investing, and book in a call with us. This is what we do. We help everyday investors find tomorrow's growth suburbs today. I'm looking forward to seeing you scheduling a session. See you at the next one.